Did you hear about the tax firm in Chattanooga? The
No.
folded? Oh man, you got to Google that.
Okay.
Funding whole life insurance to take care of the family. You have guaranteed growth, and then leverage the cash value to go buy cash flowing real estate. And the IRS allows you to do early depreciation deductions. All of a sudden, it gets fun to own an insurance contract. I look at it as a permission slip, and I know you've heard that too. But I know my family will be taken care of, and now I have permission to go take that equity in the policy or the cash value to go buy a cash flowing asset. So I have $1 that buys a death benefit. That same dollar gets cash tax-free growth. And then the same dollar is leveraged to go buy property. And the IRS incentivizes it. They incentivize me to take care of my family, and they incentivize me to go buy real estate. Chris, I don't know how to say your last name.
It's Picciurro. It looks worse than it does. And Matt, all these people with the Italian heritage who move in here from Michigan to Middle Tennessee area. But I know you have listeners and from all over the country. So
yeah, all right, Picciurro, love it. What caught my attention? We have mutual friends in the financial world, and I have an opinion about CPAs, tax preparers. I think most tax preparers are historians, and they look backwards. They say, give me your books. What did you do last year, and what can we deduct, and try and find deductions or deferrals. And then typically their saving grace is, stuff money to a qualified retirement account and we'll save money on taxes, which really is just a tax postponement. And the client gives up use of that money for a long time. And the advisor loves it because the advisor gets paid on a pre-taxed account. And the client doesn't really know any better because they don't know the options. So it's good to meet you. I don't think you're a historian when it comes to CPAs. I think you look forward and talk about strategy. So that's what we're going to talk about today. And your company is called, is it Teaching Tax Flow is the company? Is that the website?
Yep. Teachingtaxflow.com is it's a lot of things, but the company I'm with, Integrated Financial Group, but Teaching Tax Flow is our tax planning and strategy. Really, it's developed into a community. The best way I could describe it is it's kind of like Peloton for tax planning and strategy. And but yeah, absolutely. Intuit did a survey probably a year and a half ago now, and 18% of tax professionals lead with tax planning and strategy. And I think that's awful.
Wow.
I've been leading in our practice professionally with tax planning for about a decade, and it really, really makes a difference. And so in my private CPA practice, I've been operating for over 20 years. We've always put a focus on, at least in the last 10 years, specifically on tax planning and strategy. And over those years, I've just kind of developed a process for it. I developed a system, but I never had a name for it. I just did it. I explained it to people, and it worked. So about 8 years ago, I'd say maybe 7-8 years ago, I was out for a run and if anyone's in Franklin, on Mac Hatcher, the old Mac Hatcher. Now there's no Mac Hatcher. And I'm thinking, gosh, okay, our niche are really real estate investors, but people understand cash flow. But what about tax flow? Every financial decision you make has a tax ramification. So tax flow is the tax burden or benefit of any decision you make. And then it hit me like, I love teaching. And so teaching tax flow. So we've got a bunch of IP on it now, and that's our process. And you nailed it. When we were forming Teaching Tax Flow, I'm like, we have to have 3 laws. We have to have pillars of this. And we have 3 pillars. And one of the 3 pillars is that your tax return should be a verb and not a noun. So that's the first thing you alluded to. Ultimately, you're going to pick your tax, or the government's going to pick your tax. Let's just say the IRS.
Yeah.
If you don't pick your tax, then they've picked it. And if you're sitting there knowing you're not picking your own tax right now, you're not. The government's picking your tax.
Yeah.
So through this, we developed Teaching Tax Flow, and that's one of the laws. Another law is that tax agencies are your involuntary business partner. Tax laws are written to encourage and discourage certain behaviors. Certain industries have significant tax advantages, and certain industries do not. So, for instance, if you are an employee somewhere and you earn your wages on a W-2 under the Tax Cuts and Jobs Act, ultimately you pay tax on your gross income. Now you can put some money away into retirement plans and health savings accounts and stuff like that. But ultimately you're paying tax on your gross income, where as entrepreneurs, we know, and rental property owners, we pay tax on our net income. Mm-hmm. So we'd much rather pay tax on your net income than your gross income. So tax agencies are your involuntary business partner. And it could be, on the federal side, it could be state, it could be local. So that's something to consider. And one of the things you mentioned was tax deferral. So in our system, we have a process where we go through, we diagnose someone using color-coded diagnoses, because people understand colors. They
kind of like
understand.
Have you seen Noom? You ever heard of Noom?
No.
It's like a weight loss thing where it's like the food is green, yellow, or red. So
okay.
if you're eating a red food, you know that it's not great for you. So yeah, kind of the same idea.
Oh, that's interesting. Yeah. So green. So that's cool. So we diagnose clients in the teaching tax law system based on your marginal tax rate. So that'd be like your weight if you're looking at weight loss. When we prescribe different tax strategies, then we go through another process called your IQ test, identify, strategy, quantify, result, because we don't want the tax tail wagging the dog. Man, I'm sure you hear people all the time say, well, I did this for tax purposes. Like, well, you bought a $100,000 car so that you can take a deduction with bonus depreciation, but you have a $1,500 a month car payment for the next 5 years and your asset just went down. So
yeah,
I'm not saying you shouldn't buy a vehicle. What I'm saying is don't let that tax tail wag the dog.
Yeah.
And then we implement. Implementation is the key. So you've got TikTok, you've got Instagram. They're really good at spitting out diagnoses without going through prescriptions, without going through any type of diagnosis, or an implementation partner. So I'm one of the rarer CPAs that, and again, I'm all for depending on your marginal tax rate now and what we think it's going to be in the future, for potentially tax deferral. But one of the things we really teach in teaching tax law is the power of tax-free income and growth. So in our system, I feel everyone is a gold diagnosis. Gold means tax-free income and growth. There's different strategies within that diagnosis. And I think that, one of the things that irks me a little bit is that people, especially like people getting into the workforce, I've done a bunch of case studies with, let's say, a teacher just starting his or her first job. And they sit down with HR that first day and they decide, I'm going to put money into my 457 plan pre-tax, when they're basically paying no tax at that point. We don't put it in the Roth part, or do something like that. So those are things that we teach. But because you're right, when someone puts something into a pre-tax account, it's the equivalent of going to a restaurant and ordering a bunch of food and drinks and not having a price tag on it. Because quite frankly, you have no clue what your tax rate is going to be when you take that money out. And at some point, you're going to be forced to. And a lot of times people don't think that way.
Yeah, I think that's one of the biggest financial myths is there's tax savings inside of a qualified pre-taxed account.
Absolutely. There's an immediate maybe tax reduction this year. But how many people take that money that they're saving, quote unquote, I'm not calling it a tax savings, a first-year tax reduction, and deploy it into something that's worthwhile.
When we would years ago, I would sit down with clients, and I would ask 3 questions every time. Number one is, based on what you're doing today, do you think you're going to be increasing your income over your lifetime? Mm-hmm. Yes. Okay. All right. Increased income. Based on what's going on in the economy, do you think it's going to be more or less expensive to run the government in the future? More expensive. Okay, so what do you think is going to happen to taxes? Well, they'll probably be going up. Okay. Are you postponing your tax bill? Mm-hmm. And then that third question usually gets them to go, well, yes. Should I not do that? I'm not saying not do that. I'm saying if you think taxes are going to go up and your income is probably going to go up, why would we defer our tax to a time that we just agree that you'll likely be paying more than you do today? And the part that irks me is that the financial industry is incentivized to teach it. Like the advisors, they make more money to manage pre-taxed account because the government hasn't had their fair share.
Well, it's sticky, because ultimately, unless you have some type of hardship or you have a special situation, that money's tied up for 20, 30, 40 years. unless you look at it. You could take a distribution, but you're going to get penalized 10% for an early distribution in most cases, plus it's taxable.
So talk to me about loans on a 401k, because that's another thing that I think people are going, well, I can always borrow my money, and then I pay myself the interest.
Yeah.
My pushback is you're paying taxes twice now because you can't deduct the loan payment. And then you're going to pay tax. So you're going to pay tax on the loan payment and you're going to pay tax on the distribution.
Right. It unless you've got a really odd situation where you have no other options, it's not a great option, for lack of a better term. Because I've seen situations where someone's going to take a loan against their 401k, and guess what happens? They lose their job, or their employer merges with someone and they have to pay it back. Mm-hmm. Something happens that's unforeseen that triggers them to have to pay that back. And guess what? They probably don't have the money. That's why they took a loan in the first darn place. Yeah. And now it's taxable with a 10% penalty. And especially for people that are working and getting the child tax credit or maybe an earned income credit, what people don't understand is that your marginal tax rate is way different than your tax bracket. They're two completely different concepts, and your marginal tax rate is the number one KPI you should be looking at, because what can happen is if you get to a higher income level, even if it's what we call paper income, or you've got forgiveness, or you can't pay back that 401k loan, you might get phased out of a child tax credit. You might get phased out of deducting your student loan interest. So someone might say, well, I'm still in this tax bracket. Yeah, but your marginal tax rate's actually higher. Mm-hmm. And that's what we teach. Your marginal tax rate is the driver for your prescription in teaching tax flow. So do you have a program that puts people through like a questionnaire, a program that helps identify what they're currently doing and then finding the improvements? Yeah. So what we do is we have that available. We have a huge, kind of like Peloton. Like I said, I should talk to them about some referral arrangements. But anyway, someone can come in and we have a ton of complimentary educational content on our platform, on Teaching Tax Flow platform. And if someone goes through the courses, they realize that what diagnosis they are. We have something called a marginal tax rate calculator that you put in information, and it'll tell you what your marginal tax rate is, and then also what your diagnosis is. Now that is part of our premium subscription, but it's modest. I think it's $19 or $24 a month for that. You can vote at any time. So by doing that, you figure out if you're red, green, purple, gold. And then red means high marginal tax rate. Green means go. Green means lower marginal tax rate. Purple is tax deferral. Purple is probably the most overused one we have. And then gold is tax-free income and growth. And you can be multiple. Like typically, I think everyone's a gold diagnosis, and things could flip around pretty quickly from one to the other. And then once you understand those, what your diagnosis is, then you can look at different prescriptions. And then we have a bunch of complimentary. We have a complimentary Facebook group and again, all that content. Now, if it comes to sitting down and one-on-one and doing a personalized tax plan, that those opportunities are available, but they are not complimentary at that point. Yeah, that's kind of understandable. So, what is one of the biggest? We talked about the tax deferral in a qualified plan. Mm-hmm. Do you think that's the biggest problem that business owners make, or what do you see as the biggest red flag? So specifically for business owners, I would say one of the mistakes I see a lot are the people that jump into being an S corporation without understanding why you'd be an S corp and what the tax benefits could be, and also what the responsibilities are going to be. So that's to me something that I see every day. And when they should just be like an LLC? Should maybe just start off as a single member LLC, and if it makes sense to be an S corporation, grow into it, but don't just jump into it. What are some of the parameters that make an S corp a good idea? So from a tax perspective, the advantage of the S corporation is that you, instead of paying self-employment tax, which is your Social Security and Medicare, on all of your net income up to $180,000 approximately, because if you're self-employed, that's what you're going to do. You're going to pay. So let me backtrack. If you're an employee, You pay into Social Security and Medicare 7.65%. Your employer matches that. If you're self-employed, you have to pay both sides of that. That's 15.3%. And the Social Security wage base, I want to say, is like 170-ish right now. So if you're self-employed and you're making $170,000, you're paying an additional 15.3% on top of your federal tax in taxes. The advantage of the S corporation is that you don't have to pay the Social Security and Medicare tax on your net profit after you take what's called a reasonable compensation or reasonable salary. So if your net income is $170,000 and you're a notary, you must be doing a lot of notary. Now let's make a different example. Let's say you own a small cleaning company. You have 4 people working with you. Maybe they're all subcontractors, and that's your net income. Well, what you can do is you can run what's called a reasonable compensation report, something that's IRS compliant, and it might come out that a cleaner should be paid, $50,000 a year, $40,000 a year. So you would pay yourself a salary of $40,000, and then the remaining $130,000 is not subject to that self-employment tax. So that's the advantage of the S corp, is reducing self-employment tax. But what I see is that, one, people elect S corp way before they even have a Social Security savings. They might not even be profitable. 2, they're not paying themselves any type of reasonable compensation. And 3, or they're paying themselves more than the Social Security wage base anyway. Like, I'm an S corp, I'm going to pay myself a $200,000 salary. Well, your tax is going to be higher, not to get in the weeds too much, but because your Section 199A or your qualified business income deduction is based on the net profit. So S corps can make a lot of sense in some ways, but not always. And they're a lot of times they're overused. And one of the biggest red flags with the IRS is someone that's an S corporation that's not paying themselves any type of reasonable compensation. So reasonable compensation can't be 0, but you should take a look at that. You also have to analyze your state income tax as well. That's one thing I see business owners jumping into the S corp. Real story, we're working with a client now. They have 4 S corps, and they're taking like a $60,000 salary, 2 spouses from each of them. So collectively, they're paying into Social Security and Medicare 8 times.
Whoa.
Just something like that. And back to the fact that most tax professionals, they might have said you should be an S corp, and then when they started growing their business to different locations, they just figured, I was an S corp for this one, I'll be an S corp for the other one. And the tax professional is not involved in any type of the tax planning or strategy. So I collaborate with a lot of other tax professionals, because they might really be focused on tax compliance work and not tax planning and strategy.
Yeah, absolutely. Wow, that's a lot of.
It's a lot. I know that was a long answer. We only talked about S corp. So other things that business owners, pitfalls, thinking that not understanding the difference between a tax benefit and a tax deduction. Let's go back to the G-Wagon or the Escalade or something. Again, you need a vehicle. You want a cart. Of course, you're not using it for personal use very much. So you're using it for work. You want to take that bonus depreciation deduction. And let's say you can write off, 60% of it year 1 right now. I mean, laws can change. Even if you could you buy a $100,000 vehicle and you could write off $100,000 year 1, that doesn't mean your taxes got decreased by $100,000. That means your taxes are decreased by 100,000 times whatever your tax rate is. So it might be 30,000. Again, still a nice benefit, but don't let the tax tail wag the dog. And definitely, look into tax-free income and growth, and some of the strategies that you can utilize still give you some liquidity too. So let's
go over some of those strategies. Like what would be a good way to get tax-free growth and liquidity?
Well, I mean, one of the main strategies, obviously, if you're is going to be using a Roth account, but again, you don't only take out your basis. One of them is using what we call, so in teaching tax flow, we teach advanced whole life insurance planning. I know there's different names for that. Ultimately, it's building up a cash value in your whole life insurance policy that gives you liquidity. I've done it myself. And real story, I used it. I used the cash value to pay cash for a vacation home down in Florida like 4 years ago. It doubled in value, and then did a 1031 exchange, and now we've got a beautiful property. I actually, once I took the cash out to buy the property, I had to wait 6 months, and then I refinanced and put a lot of the money back in, and so becoming, so that's a great strategy, for business owners, or really for anyone, but typically business owners, when you don't work somewhere and you don't have quote unquote salary, like someone that works at an automobile company or a larger corporation, you're going to have highs and lows. We all know that. And so I would say taking a look at that, and especially because when you're self-employed, you don't have disability insurance, life insurance, all those things that could go wrong in your life. You don't have that as part of your employment. Typically, people that are self-employed are extremely highly motivated, and as long as they can get up and do the work, they're going to be fine. But humans, we are ultimately, we're unreliable, not because we want to be. We just are. We can get the flu. We can get sick. We can get terminally ill. Anything can, a family member can get terminally ill. So, not to go on a tangent about that, but that's one of the things I think business owners really should be looking at as an opportunity.
Funding whole life for tax-free growth and liquidity, and buying outside assets like a rental property in Florida.
Absolutely, because that liquidity is there for you to use and take the money if you need it to deploy. And then a lot of times you could, I think a lot of times with the advanced whole life insurance planning, people understand it. But once they realize they can pair that with other strategies, like buying a short-term rental and doing a cost seg and then putting the money back in, then it's like, wow, okay, that's all
of a sudden it gets fun to own an insurance contract. I look at it as a permission slip, and I know you've heard that too, but I know my family will be taken care of, and now I have permission to go take that equity in the policy or the cash value to go buy a cash flowing asset. And so I have an ebook we just made called 401 Cottage on 401cottage.com. And the idea is you buy rental property instead of a retirement account that I can enjoy. And my life insurance funds it all. So I have $1 that buys a death benefit. That same dollar gets cash, tax-free growth. And then the same dollar is leveraged to go buy property. And the IRS incentivizes it. They incentivize me to take care of my family, and they incentivize me to go buy real estate through the tax deductions that they allow. And those are true tax deductions, right? Not tax deferrals.
Right. Oh, real estate is one of the very few extremely tax advantaged industries. So think about real estate from its core. Even owning a primary residence, you're taking expenses that used to be personal in nature, maybe property taxes or mortgage interest, and those are now deductible. You can exclude up to $500,000 of gain if you qualify for Section 121. That's where, and people need to understand that tax laws are written to encourage and discourage certain behavior. So, for instance, man, we know a lot of people know about the Section 121 exclusion, right? You've got to live in a primary residence for 2 of the last 5 years to potentially qualify. And when I tell people, well, what do you think? Not that we all got an A in social studies, but what's the term for someone in the House of Representatives? 2 years. Well, golly, that's why we have this rule, right? Because you might have someone in Idaho that has to go buy a home in Washington, D.C. It's very expensive there compared to where they're from. They buy the house, they do their 2-year term. They don't get reelected because they knucklehead around. I don't know anyone personally in Idaho. I shouldn't say that. But, and then they sell their property to the next person that gets elected. And that guy or girl gets a parting gift of tax-free. Here you go. Here's up to $500,000 tax-free. Thanks for your service.
Wow.
And so we can use that as well. We can use our home. Now, we all could feel differently about people utilizing our home, but the Augusta rule is something that a lot of people don't realize. You can rent your home out for up to 14 days per year, tax-free. So if we both live in the Nashville area. If you don't want to be around Franklin, Tennessee for Pilgrimage Festival, which is an amazing music festival, you just don't feel like being around, and you're okay with people, staying in your house, you can pocket a couple grand tax-free. Just from the core of owning having home
We'll talk about that. So the Augusta rule, I think, is interesting. You see a lot of people talk about it and they glaze over it. So the Augusta rule, I love the story about Congress, those 2 years. Talk to me about how the Augusta rule got named.
Right. So Augusta rule is like 480A, I believe. I don't memorize all these sections, but I think it's 480A. What happened is, obviously, with the Masters, people would rent their house out in Augusta, Georgia, for a couple weeks during the Masters, because so many people go to Augusta, Georgia, and I don't know I've only been through there a couple of times, but there aren't tons of. It's not like downtown Nashville that there's tons of hotels, and a golfer is going to be there for a week. They want to bring their family, their support system. So a law got passed that said you can rent your primary residence out for up to 2 weeks tax-free. So that the people that live in Augusta would rent their house out. A lot of them would go down to Florida, go on vacation, and they wouldn't have to pay tax on any of that income. That's pretty good. That's gold strategy, tax-free income and growth.
Yeah, that's a gold strategy. And so tax-free income to the renter. And so they helped. Isn't it funny how the IRS helps wealthy people, but then the narrative is tax the rich?
Mm-hmm. Well, and that's the thing is the wealthy, and that comes down to just tax policy. There's an amazing resource called the taxfoundation.org. It's a bipartisan nonprofit that runs the numbers and on different proposals. So how many jobs will be lost or gained, how much revenue it's going to generate. And ultimately, when you increase the tax rates or attempt to tax people with a lot of wealth or income, they have the resources to plan around it. I mean, that's just the reality of it, depending on your situation. And so within teaching tax law, it's legally and ethically reduce the tax you pay in your lifetime. But there are a ton of legal and ethical tax strategies you can use to reduce that tax burden. So Augusta rule, I mean, you could use it here if you live in the Nashville area and you don't want to go to CMA Fest. Use it for that week and use it for another week. Or I have friends that live in Indianapolis that use it for the Indianapolis 500. Again, it's one of those things that you have people staying at your house, but that's just something to consider. And then some business owners use the Augusta rule to have their business rent their house out tax free for special events. So maybe retreats, maybe we all maybe work somewhere where the owner would have people over his or her property for a barbecue or for this or for that. And there's a way to get a business deduction and put some money in your pocket as long as it's reasonable. Yeah.
My tax preparer was saying that the Augusta rule has become a little bit more prominent to trigger an audit lately. Have you heard that?
I have not heard that. And also, I mean, if you're renting your house out less than 2 weeks, then there's nowhere to report it on your tax return anyway. So now, if you have a business, you would deduct it as rent. But I think that if you were audited, you would need to prove that you paid yourself, the business paid you fair market value rent. But the audit rate right now, so the IRS has a data book that they publish every year. The data book just came out last month. We did one of our Teaching Tax Flow podcast episodes on it. The audit rate's less than 1 in 200. So Think about if you pay tax for 50 years of your life, I mean, you might pay more or less, there's a 25% chance you're going to get audited in your life.
Yeah.
And the statute of limitations is 3 years. So I'm not saying go crazy, but what I'm saying is and the other thing is if you're doing things the right way, if they want to audit you, great. But yeah, 0.4, I think it's 0.48% is the raw audit rate. Now it goes up if you have more income or assets, but yeah, that's I don't subscribe to that's going to trigger an audit.
All right. What about, have you ever heard of conservation easements?
Absolutely. Yes. I do know about them quite a bit.
Are those popular still? I know they were big about a few years ago, and I know people that got in a lot of trouble trying to push them.
Right. So we have not seen conservation easements in about 4 years, I want to say. So they're, they are under scrutiny, I guess you could say. There's what the IRS is trying to, the IRS had a whole campaign where they were trying to, how do I say this? How they were trying to contact people that invested in conservation easements. And in my personal opinion, we're trying to get them to say that they were misled, or they didn't understand what was going on. Almost like, this is going to sound like a terrible analogy, but almost like the federal government going after some type of corner drug pusher. Ultimately, they want to hit the cartel, but they know they've got to start there and try to work their way up. Now, the IRS does know who does these conservation easements, and they're very, there's some bad actors out there. There's some really good ones that are airtight, that have the engineering studies, have the proper appraisals, everything like that. But what you're going to find is, at least from a financial planning standpoint, almost all broker dealers, almost all financial advisors are currently not offering conservation easements. There are some outfits. We've had a couple clients that have gone out on their own and worked directly with those organizations. But at this point, I haven't seen anything go through a broker dealer or financial advisor in 4 years.
Yeah.
So they're kind of
off the
table.
Do you hear about the tax firm in Chattanooga?
No.
Folded? Oh man, you got to Google that.
Okay, I will.
There's a tax firm in Chattanooga that was pushing conservation easements hard, ended up not paying payroll, and then just locked the doors one day, and the owner just went AWOL.
Oh, wow.
Leaving a number of very high net worth and high income individuals dry without finishing tax returns.
Wow.
And I
There's
think
an incident like that. I might be, you know what? I know there's an incident like that, and I know some just through the Tendency Society of CPAs and some other dealings. Maybe it is the same company I'm thinking of. I didn't know if they were based in Chattanooga though, but yeah, I'll check it out.
As a worm.
So, there are other strategies, like mineral rights out there and some other things.
What about art? You have any clients that deal in art?
Not too much deal in art. I mean, no, not really a ton of artwork.
I talked with a gentleman once and was talking about how you would spend, 5 figures, 20, 30,000 on pictures.
Mm-hmm.
And then you donate it years later, 5-7 years later, you start donating some of those at a much higher appraisal value.
Yeah, so that is, and that could be absolutely legitimate. So one of the strategies in teaching tax flow is to donate appreciated assets. There are some strategies called leveraged charitable giving.
Is this what the guy that bought all of Hunter Biden's paintings is probably going to do?
Maybe it is. I don't know.
Bought his painting for $500,000 and then donate it for $1 million, gets $1 million write-off. Well,
I would say the art could be somewhat legitimate.
Yeah, Hunter is great.
If you bought, let's say you bought a piece of art for $40,000 and you get a certified appraisal for $200,000, and you donate that to a charity, that could be a $200,000 deduction. There's some tax forms you have to fill out.
Who's appraising this stuff? You know what I'm saying?
Exactly.
Like those appraisers have some power.
Mm-hmm. That's where it gets. So, and then you think about that. That donation can only be, depending on what you're donating, but the most it could be is 50% of your income. So yeah, I mean there are strategies, I guess, but you've got to really diagnose and prescribe, right? I mean, there are some the strategies I like are when you actually deploy money into something and you have a solid asset, something that you own that is tax advantaged, not a K1 with some big donation deduction.
Yeah,
that because what was happening with some of these conservation easements, they're getting really crazy. They're getting 10 to 1, 12 to 1, and it just doesn't. The numbers can't work. Typically the ones that have been very compliant are about that 4.75 to 5.1 to 1 ratio.
Yeah, which is still good.
It's excellent, especially if you're in a state that allows itemized deductions.
Yeah. So I think we hit the nail on the head though. Like if you want to keep it simple as a business owner, entrepreneurial minded person, funding whole life insurance to take care of the family. You have guaranteed growth, and then leverage the cash value to go buy cash flowing real estate. And the IRS allows you to do early depreciation deductions. And now you own an asset that theoretically also hedges inflation as well. So you have cash flow before retirement. And then when you get to retirement, you could sell the asset, refinance, all sorts of options. Right. And your kids get a step up in basis, right? Like when you die.
Step up in basis is a huge tax planning strategy. And the other thing is, what people have to understand is that different types of income are taxed at different rates. So for instance, that's where when you start really getting a ton of income, you need to talk to a tax planner to determine your entity structure.
Yeah.
Does it make sense, to incorporate? Does it make sense to create a separate entity? Does it make sense? Let's say you own a plumbing business and you're renting out a warehouse. Does it make sense to go build one and pay yourself rent, fair market rent, and do a cost segregation study on that building? And ultimately, rent, like if you're self-employed, you're paying that self-employment tax, but you don't pay that on rental income. So there's a lot. I could look at a tax return with $150,000 worth of income, that it's mostly long-term capital gains and qualified dividends. Their tax rate's a fraction of someone that's self-employed at $150,000. So understand not just people get so wrapped up into what's taxable, what's not taxable, but what about at what rate is that income being taxed at? That's another thing to consider. Yeah.
I love it, man. So in the description below, we'll have a couple of links to get involved with your Facebook group, which I think you said was free. And then if they want to learn more, what the website again? Let's say that one more time.
Sure. So teachingtaxflow.com. And then, or you just find me, chrispicciurro.com. You can probably not spell it. You're not going to be able to pronounce it, but I know you have that information. And if you just click on that, and you'll find us. And,
I love it.
Yep. Defeating Taxes is our Facebook group. So defeatingtaxes.com will get you to our complimentary private Facebook group. And pretty much every Friday, we just do a free form where you can just ask any question and we're going to answer it within one day.
Yeah, I've been a little bit active in there as well. I had you asked a couple of questions, which you helped out on, offsetting, because we're going to try and sell our house. We have a little more than $500,000 of gains, so I have some tax that'll be due. And how do you offset that with early depreciation with a short-term rental? So you helped me on that one.
Absolutely, short-term rental loophole is a good is a tax strategy that can help out with that, and also put again look at that strategy. Yes, it's nice. It's a productive asset that's going to create income, but has tax benefits.
And then I get to enjoy. Like I can go see it with my family.
Exactly.
So why not get a short-term rental on the beach down in Florida?
Yep, that's what we've done, and it's awesome.
I love it. Chris, thanks so much for being here, man.
My pleasure, Matt. Thank you so much, and have a great rest of the day.
All right, brother. Talk to you soon.
Thanks.